Thank you for standing by. This is the conference operator. Welcome to the WeedMD Inc. Second Quarter 2020 Results Conference Call. As a reminder, all participants are in listen-only mode and the conference is being recorded. After the presentation, there will be an opportunity for analysts and investors to ask questions. To join the question queue, you may press star, then 1 on your telephone keypad. Should you need assistance during the conference call, you may signal an operator by pressing star and 0. I would now like to turn the conference over to Marianella Della Barrera, Vice President, Communication and Corporate Affairs with WeedMD. Please go ahead.
Thank you, Ariel, and good morning, everyone. Welcome to WeedMD's Second Quarter 2020 conference call. Please note this call is being recorded. For copies of our press releases and supporting documents filed today, or to retrieve a recording of this call, please visit the Investor Relations page of our website at www.weedmd.com. The replay will be available later this afternoon. With us today, we have Angelo Tsebelis, Chief Executive Officer of WeedMD, and Lincoln Greenidge, Chief Financial Officer. Today, we'll review the highlights and financial results for the second quarter of 2020, as well as recent developments, and provide a business and operational update. Following these formal remarks, we will be prepared to answer your questions and will be joined by Stephen Ng, our Chief Commercial Officer, for the Q&A portion of the call. I would also like to remind everyone that on today's call, we will discuss our business outlook and make forward-looking statements. Actual events or results could differ materially due to a number of risks and uncertainties, including those mentioned in our most recent filings with SEDAR. These comments are made based on predictions and expectations as of today, and other than as required by applicable securities laws, the company does not assume any obligation to update or revise them to reflect new events or circumstances. Now at this time, it's my pleasure to introduce Angelo. Please go ahead.
Thanks, Marianella, and thank you everyone for joining us today. Before we delve into the progress and results of Q2, I want to take this opportunity to provide a personal account of the year to date, as this is the first full quarter that I'm reporting on as a CEO. Shortly after being appointed CEO, I set out a plan around 3 key priorities for the company: to establish a clear vision and corporate structure, to drive the business integration, and to execute our commercial strategy and plan. It is these priorities that have laid the foundation for not only Q2, but for the rest of 2020 and beyond. The strategic shift from bulk or wholesale B2B sales to becoming a consumer-focused packaged goods company has been at the core of not only our operational transformation, but also our corporate mindset. This has been evident in our sales mix, our customer and stakeholder engagements, as well as the overhaul of some of our operational infrastructure. As such, we continue to drive the business integration in the WeedMD and Starseed operations. We successfully consolidated our medical channel onto a single platform. We reintroduced our color brand and expanded product line with new strains, launched new product formats, significantly upsized our cultivation, consolidated operations to realize greater economies of scale. We introduced automation in both labeling and packaging to drive our efficiency and speed to market, concentrated on bringing down our SG&A, signed additional union groups and benefit insurance providers, and that's just to name a few items. A critical step in righting the ship has been the continued effort to clean up the balance sheet we inherited by paying down over $12 million in payables since the beginning of the year, as well as identifying and writing down trim and old inventory from previous years. It is through decisions like these that we have managed to unencumber ourselves and continue to find efficiencies through consolidated activities and removing duplication. At the end of the day, our success ultimately speaks to our people and their ability to drive to execute the commercial plan. We have assembled the best leadership team in the industry, and our employees' passion and engagement is clearly evident in the energized cultivation, processing, and packaging teams, as well as a bolstered sales and marketing team. Notwithstanding these great accomplishments in the first half of the year, our second quarter results were not immune to the effects of COVID-19. Our inability to conduct our live education and activation initiatives with our union and insurance partners and their respective members resulted in a flattening of new patient registrations and softening of medical sales. Our combined second quarter net revenues of $5.9 million also reflects some of the changes in consumer buying behaviors, which saw a load-in of sales in late March and much of April, which ultimately included a reduction of in-store purchases, as well as reduced consumption of some retail formats, such as pre-rolls. For the 6 months ended June 30th, we recorded net sales of $18 million, compared to $11.3 million for the same period in 2019. The 6-month revenue increase in 2020 year-over-year was mainly due to the full period contribution of Starseed, the growth we've continued to experience in adult use market, and of course, the substantial sale of outdoor biomass to an international license holder at the beginning of the year. Despite COVID-19 headwinds to our business, we are encouraged by the level of consumer activity and sharp upward movement we are currently seeing throughout our operations. Since late June, net sales have continued to climb back to pre-pandemic levels as the overall industry has rebounded, and we are confident in our ability to grow near-term revenue as we continue to drive towards profitability. Starting in the second half of 2020, we have seen an uptick in customer activity, both from our direct and consumer and patient sales channels. We are on the path to profitability, as is evident by our steady improvement in gross margin performance quarter over quarter. The increased harvest as a result of our greenhouses being fully operational delivered cost per gram from clone to harvest of 55 cents in Q2, compared to 96 cents in the comparable period for 2019. Coupled with the continued effort to introduce and drive efficiencies through streamlined activities like the introduction of automation and some improvements in packaging, we feel we are in a strong position to drive through the rest of the year. We are now harvesting product from 17 rooms in our greenhouse. It's truly impressive, taking into account that 10 of these rooms were just brought online in the latter months of 2019. To note, WeedMD is currently producing the most quality cultivated cannabis that the company has ever produced in a single period. Importantly, we significantly increased our capacity in 2020 without sacrificing our product quality. We also began our second season of outdoor cultivation, which we anticipate to have an impressive harvest over the coming weeks. By building on our experiences from last year's harvest, we achieved even greater progress to date and are well on track to harvesting a crop that is looking exceptionally promising. I'm very pleased with what we've been able to achieve and want to personally thank our seasoned cultivation team for all their hard work and dedication in bringing this season to fruition. Importantly, we remain disciplined in controlling expenses and reducing our SG&A by $1.7 million as a result of ongoing integration and other operational efficiencies. Lincoln will provide additional details on our second quarter financial performance shortly. Over the past few weeks, we've shared a stream of steady news, which I encourage you to read at your convenience. But to highlight some of those, we announced the expansion of our product offerings across all channels with our Cannabis 2.0 lineup of vapes, topicals, and gels, including key strategic partnerships with Mary's Medicinals and Fire and Flower. We secured an amendment to our Strathroy sales license to include the production and sale of all cannabis formats from the site. Our adult use brand, Color Cannabis, introduced a new cultivar in Black Sugar Rose. We merged our WeedMD and Starseed medicinal channels under one streamlined platform. And most recently, we secured $30 million of non-dilutive financing from our strategic partner, the Laguna Pension Fund. This financing comes at an inflection point in our development as it provides important working capital to drive sales and marketing initiatives for both our medical and adult use brands, especially as we look to add more distribution channels for greater market penetration as the retail segment doubles in size over the coming year. I want to thank the Laguna leadership and the Pension Fund for their continued support on our shared strategic and commercial vision. Their investment underscores their dedication to delivering medical cannabis as a safe alternative to opiates, as well as the commercial value they see in both our adult use and medical service offering. In summary, despite some challenging operational conditions in Q2, we continue to make significant progress. We remain focused on executing against our vision, and we are well positioned for continued growth. This concludes my opening remarks, and I will now hand the call over to Lincoln, our CFO, who will review our financial results. Lincoln?
Thank you, Angelo, and good morning, everyone. Today, I'll briefly review the second quarter 2020 financial highlights. As Angelo has already mentioned, second quarter corporate highlights. We reported net revenue for the quarter ended June 30th, 2020, of $5.9 million, compared to $8 million for the quarter ended June 30th, 2019. As a percentage of revenue, direct-to-consumer accounted for $2.6 million, or 45%, and wholesale accounted for $3.3 million, or 55%. For the 6 months ended June 30th, 2020, net revenue was $18 million, compared to $11.3 million in the comparable 2019 period. The 6 months increase was mainly attributable to the full period contributions of Starseed, growth in the adult use market, and a significant sale of dry cannabis to a license holder in the beginning of 2020. The second quarter 2020 gross loss, before changes in fair value, was $0.9 million, 15% gross loss compared to 11% gross margin in the previous quarter and 46% in the prior year. The 15% negative margin was primarily due to $3.9 million of non-cash items, which included a $1.4 million impairment charge on inventory taken during the quarter and steps taken to automate and optimize operations at the Aylmer, Strathroy, and Bowmanville facilities. As we fully ramp up, driving towards the end of the year, we expect to see improvements in our costs at various stages along the value chain. Now, I'd like to provide some greater context into our gross margin results. Looking at our gross margin before changes in fair value and non-cash items, the results reflected a 55% gross margin versus the negative 15% reported, demonstrating our continued efforts to streamline and gain efficiencies along the value chain, as well as acknowledging the cash and non-cash impacts of our cost of goods sold. In addition, I'd like to offer some additional clarity on the inventory write-off. During the first half of the year, we conducted an inventory assessment, which is customary in our industry. After assessing inventory that was carried over from previous years, we elected to take an inventory write-down for the quarter in accordance with WeedMD's production and quality standards on saleable products. In the second quarter of 2020, WeedMD's weighted average cost of sales per gram, inclusive of all costs, direct and indirect, to produce and package, was $2.52, compared to $1.84 in the second quarter of 2019. Greenhouse cultivation cost per gram was 55 cents per gram for the quarter, compared to 96 cents during the same period in 2019. This improvement is a direct result of economies of scale, as we have increased our capacity and efficiency, including the initiatives taken at each of our Aylmer, Strathroy, and Bowmanville sites that I mentioned earlier. We expect this improvement to continue throughout the second half of 2020 within our greenhouse and outdoor grow activities. Bringing down our payables that accumulated prior to Starseed and WeedMD integration has been one of our key objectives. In fact, we've paid over $12 million in payables during the 6-month period ended June 30th, 2020. We also realized operational efficiencies in our cultivation, which is now fully ramped up. We continue to optimize our sites and, most critically, began executing on automation, which has yet to be initialized up to that point. We maintain that the growth expectation for the Canadian cannabis market and WeedMD will continue to improve as we move into the second half of 2020 and beyond. General administrative expenses totaled approximately $4.8 million for the quarter ended June 30th, 2020, compared to $4.4 million for the quarter ended June 30th, 2019, and down from $6.4 million in the previous quarter. The year-over-year increase was primarily driven by the acquisition of Starseed in December 2019 and the company's overall growth, mainly resulting in increases in salaries and benefits. However, as noted, we are seeing improvements quarter over quarter, resulting from a conscious effort to reduce overall overhead. Adjusted EBITDA loss totaled $5.7 million for the quarter ended June 30th, 2020, as compared to a loss of $0.7 million for the same period in 2019, mainly driven by the impairment charge on inventory during the quarter that I mentioned earlier. Substantial expenses incurred related to increases in production and selling and general administrative expenses prior to optimization initiatives that should reduce these costs in the second half of 2020. Please note, adjusted EBITDA is not a recognized measurement under IFRS, and this data may not be comparable to data presented by other companies. Management believes adjusted EBITDA to be an important measure of the company's day-to-day operations by excluding interest, tax, depreciation, and amortization, stock-based compensation, fair value changes, and other non-cash items and non-recurring items. This measurement is useful in assessing results of operating and strategic decisions. Net loss And comprehensive loss for the quarter ended June 30th, 2020 was $8.9 million, compared with income of $12.6 million for the same period in the prior year. The year-over-year increase in net loss is primarily a result of increased operating costs in relation to production ramp-up, expansion of the cultivation facilities, the impairment charge on inventory that was included in cost of sales, and the realized fair value adjustments on inventory sold. As for our balance sheet, we entered the quarter with cash and cash equivalents of $5.7 million. Total assets as of June 30th, 2020 reached $203.7 million, including inventory and biological assets of $38.6 million, compared to approximately $29.4 million during the same period last year. As previously disclosed, in June we amended certain terms of our senior secured credit facility entered into on March 29, 2019. Under the terms of the credit agreement amendment, we secured a deferral of certain financial covenants by 12 months to June 30th, 2021, and quarterly principal repayments as rescheduled to commence at the end of 2020. Additionally, the company agreed to a 50 basis points increase in the applicable interest rate margin on credit facility. This amendment to our credit facility will provide us greater financial flexibility to support our continued commercial growth and our expanded distribution channels. And more recently, as Angelo mentioned today, we entered into a $30 million credit facility with Luna Pension Fund. This non-dilutive financing matures in June 2022 and provides the company with the financial flexibility to drive WeedMD's commercial initiatives during the next stage of growth. For further information on our financial and operating performance, I encourage you to review the company's financial statements and management discussion and analysis for the quarter ending June 30th, 2020, which have been filed and are available through SEDAR. Before turning the call back over to Angelo, I'd like to talk about the current state of the COVID-19 pandemic, how it has impacted our business, and our expectations going forward. Throughout this pandemic, WeedMD has continued to conduct its operations to the fullest extent possible, while continuing to take actions to protect the health and safety of our employees, suppliers, and customers. During the first quarter of 2020, the coronavirus did not have a material impact on our business. As we progressed through the second quarter, we experienced a decline in sales relative to the first quarter, which in part can be attributable to economic uncertainty caused by the pandemic. Towards the end of the second quarter and early in the third quarter, we began to see increasing customer activity in the majority of our markets, reflecting the reopening of the Canadian economy and the steadily decreasing impact of COVID-19. This positive momentum has continued throughout the third quarter to date, including increased sales since the onset of the pandemic. While we remain optimistic that operating conditions will continue to improve, we will remain prudent and continue to be disciplined in controlling our expenses. We intend to continue improving our operating efficiencies, which will enable us to deliver improved margins and meet increasing consumer demand as the market for Cannabis 2.0 products continues to develop. Additionally, the $30 million credit facility from the LPF will provide us increased financial flexibility as we continue to expand our distribution channels and brand awareness, which should drive further revenue growth. With that, I'll turn the call back over to Angelo for closing remarks.
Thanks, Lincoln. In conclusion, we are very excited about our prospects for the remainder of the year and beyond. We accomplished a great deal during the first half of 2020 and are proud of what we have already achieved. Importantly, we have laid the groundwork for our continued success moving forward, even as we face some challenges and took some difficult steps along the way. As we move forward, we will continue to focus on driving increased revenues and gross margins, expanding our product offerings in both traditional and Cannabis 2.0 formats, and leveraging our strategic Starseed platform to drive organic growth across all our medical channels, optimizing our Color and Saturday Cannabis brand presence, and further growth in the adult use sales. forming new commercial partnerships to generate incremental revenues, and exploring new ways to enhance our customers' overall experience. My team and I want to thank our employees and shareholders for their continued confidence, patience, and support, and we look forward to updating everyone at our Q3 earnings call. Now we're happy to take your questions.
Thank you, Angelo. This concludes our opening remarks, and we're now ready for the question period. Ariel, please proceed with the instructions to call in.
Certainly. We will now begin the analyst question and answer session. Any analyst who wishes to ask a question may press star and 1 on their touch-tone phone. You will hear a tone to indicate you are in the queue. For participants using a speakerphone, it may be necessary to pick up your handset before pressing any keys. If you wish to remove yourself from the question queue, you may press star, then 2. Once again, to join the question queue, please press star, then 1 now. Our first analyst is Neil Gilmer of Haywood Securities. Please go ahead.
Yeah, good morning, guys. Maybe wanted to start, Angelo, on some of your prepared remarks. Just try to make sure I understand or the takeaways is accurate. You commented to say that you're sort of seeing sales now above the pre-COVID-19 levels. So I assume that's sort of what you're sort of seeing most recently, perhaps in the month of September. But for Q3, I'm trying to get a feel for whether we're expecting, growth off of the Q1 level or growth off of Q2, but still, maybe still not quite back to where we saw. And when I refer to Q1, I'm excluding that, obviously, that wholesale payment. I'm more looking at sort of the direct to patient and the wholesale into the provinces. Or any sort of further color you can provide on sort of what those sales levels you've seen recently are?
Sure, and thanks for your question, Neil. Hope you're well. Definitely, and obviously, without trying to provide any sense of formal guidance, the remarks are really about coming back to monthly and run rate that we were seeing really going into March. We really, as you recall, coming into this late January and early February, we really had that focus around turning around not just our medical sales, but reintroducing that color brand. And so we were really starting to see that ramp up. Obviously, close to the end of March, once the pandemic hit and things became a little more serious, we saw that pulling forward, that stockpiling, if you will, of in all industries, not just cannabis. There's some seasonality to our medical business, but more importantly, what that coupled with COVID, I think what we're starting to see now is sort of mid-August and really in the latter part, September in particular, we're really starting to see that rebound back to what I would say the Q1 run rate that we were seeing. So feeling quite positive about where things will net out. We haven't obviously calculated Q3 yet, but when I think about our results, they'll probably be closer to a jump-off point of Q1 than Q2.
Okay, thanks. Appreciate that. And then can you provide a little bit more color on the medical side? Like if you go back, obviously I guess when the transaction with Starseed closed, let's call it towards the beginning of this year. And, I guess the philosophy there was as far as the ability to grow that medical side through some of those agreements. Is there, any sort of anecdotal comments you can provide as far as how that's progressing, I guess maybe again, post sort of the main disruption in Q2?
Yeah, happy to. I mean, just to reiterate, our model is quite unique, right? They are signed partnerships and arrangements with unions, employers, and it's really all about that cannabis as a paid benefit, quite frankly. The significant driver of our business is obviously patient registrations, and a lot of that had to do with our ability to be there in person and activations and really around driving awareness through education. Obviously, with social distancing, that's significantly flattened. The other piece is we had a number of new partnerships that were lined up that we were prepared and hoping that we'd be announcing in Q2. Obviously, financial prudence during a global pandemic is something that has slowed some of those, what I call B2B discussions. And, we're optimistic that we might see some of that materialize in the latter half of the year, or it may actually get pushed out to 2021. We'll see what that looks like. But there is inherent seasonality in some of that medical business, and we tend to see a bit of a flattening during the summer months. That coupled with the pandemic is kind of where we saw that compounding effect. But I'm again quite positive and quite optimistic, just given the most recent month and the last number of weeks that we are starting to climb back into that regular run rate and growth rate that we were experiencing.
Okay, thanks. And then I didn't quite hear clearly one or two of Lincoln's comments on the gross margin. So I just want to make sure I have my takeaway here. I believe he said $3.9 million in total non-cash charges, and that included a $1.4 million impairment. And I think he mentioned if you normalize, if you exclude some of those one-time items, what would your normalized gross margin have been for the quarter?
Yeah, it's Lincoln. That's correct. I thought it would be important to provide a bit of color on our cost of sales and certainly our gross margin, because we did absolutely have $3.9 million of non-cash items. And when you back that out, you get 52% gross margin.
Okay, yeah, that is helpful. Thank you. And then sort of you took that impairment on the inventory, and obviously you promised you still have 35 in inventory and some more in biological assets. But do you feel now that there's at this current time, I guess I understand how the market can always change, but you're not expecting further impairments? You sort of feel like you're comfortable with what you've done with that impairment?
Well, the way it works is that you have to look at the assessment that has to be done on a periodic basis. Certainly from our standpoint, we believe that the inventory that is currently on our balance sheet is what will be sold. And we were doing everything in our power to ensure that we have the sales team, hitting the road and working through all the markets to sell every single product that we have. So that's basically where things are at this point.
Okay, thanks very much. I'll leave it there and let other analysts jump in. Thanks.
Thanks, Neil.
Thank you.
Our next question comes from Patrick Sullivan of 8 Capital. Please go ahead.
Good morning. Thank you for taking my questions, guys. I don't understand the headwinds experienced in Q2. I've definitely seen not only in WeedMD's results, but in other companies as well. I was wondering if you guys, do you guys have any sense of where your market share was in the context of Q2? Was that, were you still able to grow it, or was it in line with Q1, or anything you can offer in that regard?
We have some insights, and maybe I'll turn it over to Stephen to.
Yeah, hey Pat. I think it varies by province, but just to give you a sense, I think our market share was probably relatively flat. I would say in some of the key provinces that we're in.
Okay, great. Thank you for that. And then I guess just for in terms of ramping things up, and you guys had some press releases about 2.0 products and launches. When do you expect that stuff to really hit the income statement? Like when were orders taken out, or when were things shipping? And will it be meaningful in the next quarter?
Yeah, fourth quarter. Yeah, fourth quarter will be the quarter when we'll see that revenue hit our P&L.
Okay, awesome. And then we're starting to hear more and more about the outdoor crops and getting ready to harvest and stuff like that. I'm wondering, how are buyers assessing the quality of the outdoor products? Because it sounds like there's going to be quite a bit hitting the market, and I'm not sure exactly how people are being assessed, I guess, on quality. Is it just THC content at this point, or are there other metrics that people are looking at?
I'm happy to kind of at least give initial thoughts, and Stephen, feel free to jump in if there's anything I leave out. Typically, we were actually quite happy with the way we were able to commercialize some of our product last year. We actually found some of our outdoor being used in our finished goods and not just necessarily moving into extraction as most might think. The challenge obviously is with outdoor, there are a number of risks, and it's difficult to truly plan on what those product formats could be. We have obviously our pre-roll formats, we have our ready to roll, and we were quite happy with the cannabinoid content and terpene profiles that we had last year, and we think this year should be just as good, if not better. So we'll, fingers crossed. I mean, at the end of the day, we are in the final stages right now, and as we mentioned, things are looking quite good. The challenge is all the various materials that we would also find in those products, right? And so, for the most part, we don't plan on being able to sell dry bud, for example, as from the outdoor, just because of the variability of the product. Now, some of it is looking quite good, and it might be possible, but for the most part, you're right. There is a lot of biomass that looks like it's coming online, and I guess it really will come down to the overall quality, because as you know, cannabinoid content and THC levels continue to be the primary drivers. Failing that, you end up having just a lot of input material otherwise. And so I think that would be the key. I think we're feeling good about where we're at.
Okay, great. So just to be clear, it sounds like that the dried flower is going to be directed to mostly, extracted products as like the end product, not sold as, dried product, dried bud.
We will do both. We will have pre-rolls and our ready-to-roll formats, absolutely. It's just it won't be sold as I said, whole bud.
Okay,
and then, yeah.
Got it. And then one last one here from me, and I'll get back. Is there anything you guys can provide with respect to, CapEx for the remainder of the year? Is there some sort of a guidance on that?
Oh, we don't have official guidance, but we've been saying all along that our infrastructure is actually quite solid. We're in a very positive position that at best it remains modest. There are some maintenance and slight improvements that we continue to make, but there is no material capex that is required to fulfill and execute against our plan.
Okay, great. Thank you.
Our next question comes from Chris Dumas of BCMI Research. Please go ahead.
Yeah, good morning. Thanks for taking my question.
Morning, Chris.
If you multiply the grams by the volumes, you get 4.84 million in sales, but there's 5.8. Where's the other million in revs? Is that something else?
Chris, the difference is extracts. The kilos that were reported were sales of dry flower.
Okay. So you don't do an equivalency and report extracts?
No, we don't.
Would the extracts be in the medical area, you would think?
Yes, primarily in the medical channel.
Okay. Secondly, what was, just for housekeeping purposes, what was the harvest during the quarter, obviously, from the greenhouse?
Lincoln, do you have that handy?
It was just over 6,000 kilos.
Great. And lastly, the white label deal with Fire and Flower. Have you got more retailers that you're working with, or do you have to exclusively work with Fire and Flower?
The agreement with Fire and Flower was a great opportunity for us to work with a retailer. It is not exclusive, so we certainly have the ability to work with other retailers and, frankly, any other partner around product and brand partnerships. So, I think we've seen continued interest in that from other groups, and we'll continue to assess those on an individual basis.
Great. Thank you very much. Good quarter.
Thanks, Chris.
Thanks, Chris.
Once again, if you have a question, please press star, then 1. Our next question comes from Greg McLeish of Mackie Research. Please go ahead.
Hi, guys. Just a couple of questions. What do you think your cash break-even is on revenue right now?
I'll let Lincoln.
So, Chris, what I could say is we're proceeding with our plan to become cash positive in 2021, and our plan remains that way. We don't provide guidance specifically to our exact break even, but if you look at our numbers, I think it's in line with in reaching to that point. With the recent $30 million that we've received in financing, we believe that we now we have the flexibility to execute on that plan.
But it looks to me that if, what would be a good sort of gross profit number? If, if I use 35-40%, you guys are going to have to generate at least north of $60 million in order to be cash break even, if I'm not correct.
No, I wouldn't say that, actually. I think we could certainly, we will certainly reach break even at a lower revenue number, and here's the reason why. What steps that we're currently taking, number one, obviously to grow our top line and our revenue, and we've been invested in our sales team, but also, and you will see that, and we're committed to doing that, you'll see the reduction in costs continue to be demonstrated, not just throughout the value chain, from cultivation all the way to packaging. And ultimately, that's what will drive our break-even number, right? So the results now, and I think I may have mentioned that previously, you need to strip out some of those accounting adjustments that continue to mask the true performance. And when you strip that out, I think you will notice that we actually are or will get to a break-even number at a lower revenue number.
Well, I guess my concern here is that you're continuing to burn through cash. You've got the new LIUNA credit line, which is good, but it's at 15% interest rates. I mean, that's $4.5 million per year. Now, I know you can do a payment in kind, but what my concern is that you're going to absolutely dilute the equity shareholders going forward, because you've got a high debt position, and when the share price is where it is, it's hard to raise equity at these levels. So what comfort can you give to the equity shareholders of the business that you can generate a long-term return for them?
So I think I'll take that, and if Angelo or Stephen want to add some color, they can certainly do so afterwards. I'll reiterate that the comfort I give certainly shareholders in terms of not diluting their interests is that we will become cash positive, and we will be able to service our debt. The plans that we have in terms of automation, we continue to automate. We continue to look at all our costs and reduce. And I'm seeing the signs right now as we go into, I guess, the Q4 now, that we can reduce our costs significantly in order to continue to reach to that or meet our plan. And that plan is obviously to become a sustainable, profitable business. Once again, it's something that I believe firmly that we can do. We've seen the signs that it's happening. Certainly at the top line, we're growing our revenue, and as I indicated before, you will see our costs continue to come down. Obviously, relatively to the increase in sales.
Great. I'll get back in the queue. Thank you.
Thank you.
Our next question is a follow-up from Patrick Sullivan of 8 Capital. Please go ahead.
Yeah, hi guys. Just one last one for me. I was just wondering. I know the credit facility closed very recently, but has there been any draw on it? If you can share that.
Pardon me. Can you repeat the question, Pat?
Sure. Have you guys drawn on the credit facility at this time?
No, we haven't.
Well, sorry, just to clarify, the structure of the debt is it's not structured as a revolver or an accordion, so it's a one-time bullet. So we are in receipt of cash from the issuance of the debt.
Yeah.
Understood. Thank you.
This concludes the question and answer session. I would like to turn the conference back over to management for any closing remarks.
I'll just once again thank everyone for attending today's call and for your continued interest in our company and as we said, in your continued patience as well. We look forward to having follow-up conversations with many of you and to updating your continued progress. Thank you all again and have a great day.
Thank you.
Thank you.
This concludes today's conference call. You may disconnect your lines. Thank you for participating and have a pleasant day.